Recently published inflation data has grown unexpectedly. March CPI increased at a rate faster than expected, accelerating to 3.5% year-over-year. Core CPI also accelerated to 3.8% from February, contrary to expectations of stabilization, marking the third consecutive month of exceeding forecasts. Judging from the 3-month-on-year data, it is even more frightening. Core CPI has continued its rebound trend since August last year and is now moving further and further away from the Federal Reserve's 2% inflation target. This ongoing surge in CPI inflation has dashed investors' expectations for a rate cut by the Federal Reserve. The latest market pricing indicates only a 50% chance that the Fed will cut rates for the first time in July. Goldman Sachs has also delayed its projection for the first rate cut from June to July, expecting 2 rate cuts within the year. These accumulating signs have sparked market concerns and panic, fearing that the Fed may not cut rates this year. The panic around secondary inflation has now become a reality. A key reason behind secondary inflation is the spiraling rise between corporate profits and household income. For consecutive quarters of rebound in corporate profits and high production profit margins have provided a solid foundation for the growth of residents' salary income. U.S. non-farm payroll data showed that 303,000 jobs were added in March, far exceeding the expected 200,000. This indicates a strong demand for labor, which also supports the growth in wage income. Additionally, U.S. consumer spending is returning to pre-pandemic levels. Real PCE for services increased by 0.6% month-over-month in February, marking the largest growth since July 2021, highlighting strong demand in service consumption. The robust growth in service consumption, especially in low-skilled service industries, has brought new pressures on inflation. Faced with continuously rising inflation data, the Federal Reserve seems to still maintain its monetary policy stance, believing there is no necessity, room, or incentive for a significant rate cut. Despite the continuous rise in energy prices, if oil prices rise rapidly and cause inflation expectations to decouple, the Fed may not exclude the worst outcome. Without the kind of outsized exogenous shock seen in the 1970s oil crisis, the scale of secondary inflation is unlikely to return to the peak levels of 2022, but is more likely to experience a round of moderate demand-side inflation. However, there is no need to be overly concerned, as the worst phase has passed. With the release of subsequent data, there is a chance for market expectations to adjust positively. Since interest rate cut expectations can be quickly reduced from 125 basis points to 50 basis points, it cannot be ruled out that they could be quickly adjusted back to 100 basis points.